Welcome to Iron Financial. We're the channel with one single mission, to help you forge a stronger portfolio and cut right through all the market weakness. And today, man, we are putting a true titan under the microscope, a company that is right at the absolute epicenter of the AI revolution, Broadcom. So the question we have to answer is this stock a fortress of impenetrable strength, or is it just an elaborate, high-priced trap waiting to spring? Let's get into it. We have to start right at the top with a quote from the man in charge, CEO Hock Tan. Now, you got to understand, this isn't just some casual statement. This is a declaration of dominance. He's not just talking about some nice gradual growth. He's practically shouting about acceleration from the rooftops. And this sets the stage perfectly, because if you want to understand Broadcom, you have to get this. AI isn't just part of their story, it is the story. It is the central pillar holding this entire massive structure up, and today we are here to test its load-bearing capacity. And believe me, that pillar is supporting some serious weight. Just look at this number, $19.31 billion in revenue for a single quarter. Folks, this isn't just a good number, it's an absolute blowout. This is the kind of figure that builds the foundation of a financial fortress. A number that doesn't just meet expectations, it completely pulverizes them and sends a crystal clear signal to the market that this machine is running at full throttle. This right here, this is the bedrock we're building on today.
Okay, now what's really interesting when you look at this chart is the context. See, it wasn't just a win, it was a decisive, clean victory. Wall Street analysts, the people whose entire job is to predict these things, they were expecting $19.18 billion in revenue. Well, Broadcom came in and delivered over $100 million more than that. They expected earnings per share of $2.03. Broadcom delivered $2.05. Now, these might look like pretty small margins, but at this scale, this is a demonstration of powerful, precise execution. They didn't just meet the high bar, they cleared it with plenty of room to spare. And that, right there, is the mark of a well-oiled operation. So, here's the crucial question, right? Where is all this strength actually coming from? If we want to truly understand the integrity of this financial fortress, we have to drill down past those shiny surface numbers and really inspect the core of the engine that's driving this incredible performance. And that engine, well, it has a name: artificial intelligence. So let's pop the hood and take a good look at the schematics. This, right here, this is the high tensile steel reinforcing the entire company. $8.4 billion in a single quarter's revenue from AI alone. That is a 106% increase from the exact same time last year. It didn't just grow, it more than doubled. Let's be clear, this isn't just growth, this is explosive exponential expansion. This is the #1 reason for all the market's excitement, and frankly, it's a number that is just incredibly difficult to argue with. It's pure, raw power. And in this market, power is what forges profits. So how are they forging this kind of dominance? Well, it's not just one single product. It's a whole ecosystem. As you can see right here, first you've got their custom AI accelerators, their XPUs. Now, these aren't some off-the-shelf chips you can just buy anywhere. Nope, these are custom forged pieces of silicon for the giants. We're talking Google, we're talking Meta. Broadcom is essentially the exclusive armorer in the AI arms race. Second, they absolutely dominate high-speed networking and Ethernet switching, which are the vital arteries that allow these massive data centers to even function. Third, their deep relationships with players like OpenAI make them indispensable. And just look at that last point. They're forecasting $10.7 billion in AI revenue for Q2. They are literally telling the market the engine is just getting warmed up.
So this chart does a great job of laying out the whole business. On one side, you have Semiconductor Solutions, that big engine we've been talking about, making up a whopping 65% of the pie. On the other, you have Infrastructure Software, a pretty substantial 35% slice. It looks solid, right? A two-pronged titan. But hold on a minute. It looks solid, but is it? I mean, 65% is a whole lot of weight for one single division to carry. When I see a chart like this, I can't help but ask, is this actually balance, or is it a dangerous imbalance just waiting for something to go wrong?
That's exactly the right question to be asking. The AI engine is a marvel of engineering. There is absolutely no doubt about that. But we don't just sit here and admire the shiny parts. It's our job to act as engineers and stress test this entire building. We need to look for any potential weaknesses, any of those little hairline fractures that could become major, catastrophic problems under pressure. It's time to check for cracks in the armor. And this slide right here is Exhibit A. It's a tale of two completely different businesses living inside one company. On the left, you have the AI-driven Semiconductor Solutions, and it's growing at a blistering 52% year over year, an absolute beast. But then, look at the right side. Infrastructure Software, a multi-billion-dollar business, grew at just 1%. 1? That's not growth, that's stagnation. So the critical question becomes, can this raging bull of a business drag this absolute behemoth of a legacy segment behind it forever? That is a very, very heavy chain.
And to add insult to injury, it's not just that the software segment grew slowly. It actively underperformed. I mean, the market, the analysts, they were already expecting pretty modest growth of just 2.6%. And Broadcom's software business couldn't even clear that low bar, coming in at just 1%. Listen, when a company misses expectations that have already been lowered, that's not just some little red flag, that is a blaring siren. It suggests there might be a much deeper issue here, a real crack forming in that part of the foundation.
Whoa, hold on. Before we sound the alarms, let's look at the complete blueprint. A single, slow-growth segment doesn't condemn the entire structure if the overall operation is incredibly efficient. And this table right here proves that it is. Adjusted EBITDA is a massive $13.1 billion. That's 68% of revenue. An operating margin over 40%. A net margin over 36%. These aren't just good numbers, they're elite. This proves that the company as a whole is a fortress of profitability. They are managing the entire structure with incredible efficiency, turning revenue into pure profit, no matter where that revenue is coming from. This isn't a company that's patching holes. It's a fortress built of pure profit. But that's exactly the pressure point. S&P Global puts a finger right on the potential fault line with this quote. That fortress of profitability you're so proud of, well, it might be built on shifting sand. And why is that? It's because the source of that explosive growth, that AI silicon and networking, it has lower margins than the high-margin, slow-growing software business. So as the company's revenue mix shifts more and more towards AI, the overall profitability percentage could actually start to go down. The engine is getting bigger and faster, but it might just be less fuel efficient. Exactly. And there are other stress points we absolutely need to consider. Look at this. First, insiders, the people with the actual blueprints to the entire building, they've made 12 sell transactions in just the last 3 months. That's a signal you simply cannot ignore. Second, the stock's beta is 1.14. In simple terms, that means when the market catches a cold, this stock gets the flu. It's more volatile. Third, that valuation, a price-to-earnings ratio of nearly 67. That is a sky-high price tag. And finally, an independent valuation model from Guru Focus suggests a fair value of around $242, and they're labeling the stock significantly overvalued. These aren't just little hairline fractures, these are deep fissures that could bring the whole thing down. All right, valid points. But let's shift the debate here. Let's move from the income statement to the balance sheet, because this is where you find the true structural integrity of a company. Do their financial decisions actually reflect a foundation of absolute strength? Or are they just using capital to paper over the cracks? Is this a sign of capital confidence, or is it a warning?
This chart right here is the answer. This is undeniable proof of financial health. In a single quarter, Broadcom generated $8.26 billion in cash just from its operations. And after all capital expenditures, they were left with $8.01 billion in pure, unadulterated free cash flow. This company isn't just a machine, it's a cash-generating waterfall. And look at the reservoir they're sitting on. Over $14 billion in cash and equivalents. This is not a company that's struggling to patch holes. This is a fortress with a deep, full moat.
And what do you do when you have that much financial firepower? You signal absolute confidence to the market. $10 billion. That is the size of their new share repurchase program. Management is stepping right into the market and saying, we believe our stock is so valuable, we're going to use $10 billion of our own money to buy it. This isn't just some financial maneuver. It's management putting $10 billion of their money right where their mouth is. They are literally reinforcing their own structure. And this just brilliantly illustrates their commitment. In a single quarter, Q1, they returned nearly $11 billion to shareholders, $3.1 billion in dividends, putting cash directly into investors' pockets, and $7.8 billion through stock repurchases, which increases the value of every single remaining share. This is not a company that's hoarding cash out of fear. This is a company demonstrating a level of financial firepower that most other companies can only dream of.
The cash flow is a fortress, okay? I'll grant you that. Nobody can argue with those numbers. But that brings us right back to the most critical warning sign of all, the price. A PE ratio of 67, a price-to-sales ratio of 24. These aren't just high, they're in the stratosphere. What this means is that the market hasn't just priced in the company's current success. It has priced in absolute perfection for years and years to come. So while the cash flow is incredibly strong, the valuation leaves zero margin for error. Any slip-up, any sign that AI growth is decelerating, and a structure built at this altitude doesn't just fall, it plummets.
Okay, we've examined the blueprints, we've stress-tested the foundation, and we've inspected the financial framework. The bull case is crystal clear, a dominant AI engine that is just printing cash. The bear case is also pretty clear, an unbalanced business with a sky-high valuation. Now it's time to weigh all the evidence. It's time to forge a final verdict for your portfolio. Is this an opportunity or is it a trap?
All right, let's walk through this logically. We've established the incredible strength of the fortress, and we know it's built on the bedrock of AI. We've also identified the potential fault lines, the slow software growth, the pressure on margins, and that crazy valuation. Now, let's combine these findings to reach a final, actionable verdict.
So on one hand, the case for the fortress is just incredibly powerful. You have unmatched triple-digit AI growth, you have a dominant, almost monopolistic position in custom chips for the world's most important tech companies, you have massive, undeniable free cash flow, and a management team that's aggressively returning that cash to shareholders. It's a picture of immense strength. But on the other hand, you absolutely cannot ignore the fault lines. That software segment is stagnant and actively underperforming. There's a real analyst-backed concern about future margin compression. The valuation is priced for absolute perfection, and the people on the inside, the ones who know the most, they're selling. It's a clear conflict.
So here is our final synthesized verdict. Broadcom is not a trap, but it is a highly specialized opportunity. You have to think of it like a high-performance machine, maybe like an F1 car of a stock, but one that is built on an incredibly narrow yet high-strength foundation. And that foundation is pure AI. Its strength is immense, but it is highly concentrated. The sky-high valuation, then, isn't just a sign of hype. It is the price of admission you must be willing to pay for direct, undiluted exposure to the very core of the AI hardware revolution.
And that leaves us with the final question, the one you have to answer for your own portfolio. With a structure built so singularly on the foundation of pure AI, is Broadcom's current stock price a skyscraper built to last for the next decade? Or is it a tower reaching a dizzying height that the market and its own fundamentals simply cannot sustain in the long run? That's our analysis. Now, it's time for you to do your own due diligence. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.